All right, we are live, guys. So the five biggest losers in my portfolio are all down over 20%. 20%. And in tonight's live stream, I'm going to share with you which stocks these are, and also why out of these five, I'm only averaging down on one of them. But before we get into that, welcome to another Dividend Happy Hour. I hope you guys had a fantastic week, and I'm so stoked to have you guys back here with me for another week. I think a cheers is in order. You guys know how we kick these things off. And we never know what to cheers to. I'm always kind of making it up as I go, but I think we need an official toast for the weekly Dividend Happy Hour. So guys, here's to the yield, here's to the growth, and here's to that sweet, sweet cash flow. And also here's to you guys. Thank you again for joining. I'm happy to see you. So as you guys can see right here, I'm sipping on a Coke Zero. Shout out Coca-Cola. Shout out ticker symbol KO. But I want to hear from you guys. Let me know in the live chat here, what are you sipping on tonight for the Dividend Happy Hour? And also let me know which stocks you added to your portfolio this week. What did you pick up? It was a good week to swoop some stocks at a discount. Peanut's he's already up to something over there. He's had a little too much Coke Zero tonight already. But yeah, let me know in the live chat what you guys are sipping on and what you bought this week. And also, if you're watching the replay, let me know in the comments below. I'm going to give some shout outs real quick to all 83 of us here in the live stream so far. We've got Kevin. I see Ma is here. She is ready. Sunshine. Oh, gosh. Goodness gracious. Pat's here. G-Man, Thomas, CG. I see Sean, Luis, Jeff, Mr. Zach Attack. We've got Adon. And also, yeah, happy Cinco de Mayo, everyone. Happy Cinco de Mayo. So I'm sipping a Coke Zero right now, like I mentioned. But for tonight's after party, I will be sipping on a margarita. So that's not something you guys are going to want to miss. And on that note, guys, please join the after party with us. The after party is a bonus live stream that we do every single week that begins immediately after the Dividend Happy Hour ends. And it's a Patreon exclusive live stream. So you can only join this after party by joining the Patreon community right there. The link to it is also in the description below. And it's really cool. I mean, every single week, this is kind of the format. Give you a main portfolio update, do a little bit of a deep dive into my main portfolio. And we also have a Patreon exclusive portfolio called Peanut's Portfolio. And that's my cat Peanut right there. You can see he's taken a nice big nap after a little Chipotle. You can see the Chipotle bag right there. And then we also just keep the party going with a little Q&A, which I think is everyone's, favorite part about coming to these Dividend Happy Hours. So it's a lot of fun. It's a really great way to support the channel and the work we're doing here. So I'd love to see you guys all over there on the in the after party. And once again, I'm going to be sipping a little margarita over there tonight, just in celebration of Cinco de Mayo. So, and I haven't had a margarita on the live stream for a long time, so this will definitely be a sight to see. I think it's been a while since I've had any alk, actually. I've been really good. I've been dieting down, and so I've kind of been cooling it on the alcohol. But we're gonna have a little fun tonight. So only on the after party though. But anyway, no, we're gonna have fun here too. But anyway, getting back, Shamir's here, Chris, Gorilla, Dominique's here, Brad, the Drip Dog. I like that name. That's really cool. Clayton's here, also drinking a Coke Zero. Cheers, man. That's very cool. We got New Gen Old Lifts. Chris, I think I already said what's up to Chris. Miguel, Cheryl, Ricardo's here. Very nice. Excuse me. El Dynamico says, quick shout out to all of us here. I'm performing tonight, so I can't make it to the show. Have a good weekend. Good luck in your performance, my friend. That's very cool. Best of luck. Break a leg. Who else we got? Steve's here. Phil's here. Kimpoy, Jim, Shaded Light, sipping on old Pepsi. And as far as some purchases here, let's see. I'm seeing, scrolling up a little bit here, I'm seeing, and just real quick for those of you who are just now joining the live stream, looks like there's about 115 of us in here. I'm going to be sharing with you guys 5 stocks that are just really kicking my butt right now. They're the 5 worst performers in my portfolio, and all of them I'm down over 20%. But out of these 5, there's only one that I'm still actively buying, still actively averaging down on. So we're going to get into that in just a moment. But first, it looks like Miguel picked up some QCOM and RHI, which is Robert Half International. Really good company, really underrated company, actually. Let's see here. It looks like the Drip Dogs. I'll be putting $125 per week into Realty Income for my Roth. Very nice. Looks like Luis picked up a bunch of SCHD some JEF, which I'm not familiar with, and also some Ally. That's very nice. Let's see here. And Jim says, running late, running to the fridge for a chilada in celebration of Cinco de Mayo. Let's see here. Shamir picked up some really nice shopping spree from Shamir this week. TD, J&J. I mean, you guys can see them all right there. A lot of different ticker symbols. Very good. Mr. Zach Attack with some Leggett & Platt, Philip Morris, and Coca-Cola. Very nice. And we got to give a quick shout out to my man Leroy here, who did it. He just passed, and I actually think I saw this on Twitter, man, passed 1,000 shares of SCHD on this beautiful dip. So, man, congratulations. That's what we should have been cheersing to tonight. We should have toasted that. That's a really cool milestone. And let us know real quick in the live chat what exactly, because there was some sort of SCHD challenge you were doing, right? And I think a handful of people over on Twitter are doing the same SCHD challenge, but I don't quite know what it is. So let me know in the live chat what that was. That sounds like from what I remember, is a pretty cool thing, just like buying SCHD every week in some capacity. And Ultra Runner actually hit the same milestone. That's pretty wild. Got 1,000 shares of SCHD this week, so good stuff. And then Chris here says he was really hyped about this. We were talking about this in the Discord. About over 17 shares of GDX, a new position. And Chris is a trader too. That's part of his strategy. So he'll buy and sell. So good stuff, man. Hopefully that works out for you. Also got one SCHD and one Pepe coin. Okay, very nice. Let's see. Jason here said, sipping on some Buffalo Tracer while picking up some Vici. Nice. I listened to Vici's earnings call earlier this afternoon. Very nice stuff. Looks like G-Man also picked up some Vici. Good stuff. And we'll go through a couple more, then we'll get into the main event. Okay, guys? Sean with some BXMT. I'm not familiar with that. I think all of these are, correct me if I'm wrong, but I think all of these are high yielders. Maybe not NTST. I'm not too familiar with any of those tickers. Let's see here. Lucas, what's going on, Lucas? Picked up, or sipping on some ginger ale and bought some more CNR this week. So real quick, kind of really big sidebar, but it was in the corner of my eye. So you guys know, I mean, you can see it on my hand right here. You can see it on my arm. I've got the blinds right there. The light's just kind of shining through, kind of weird. You can see it on the shirt. So right before the stream started, this was all on my face. And so what I did, I have these foam sound absorption pads that I have right here just to absorb sound, so it's not bouncing off the wall. I had to stick 2 of those into my blinds to get the light to look a little bit better. So hopefully that fixes the problem, because it's been an issue for the last few weeks. But anyway, let's keep going. Oh, Miguel says here, I've been a little bit busy with life, but looking forward to joining the Patreon. Looking forward to seeing you over there, man. Definitely looking forward to that. Jack Murphy in the building. What's up, Jack? I haven't seen you for a few weeks, man. Hope you're doing well. TCAF, what is going on? Hope you're doing well as well. And then last but not least, we've got my man Haas here. What's going on, Haas? Let's see here, guys. A couple more. I'm sorry, guys. SCHD and Realty Income for Jack. TCAF picked up some Cube. Quite a handful of different stocks, actually. And James here says, okay, and we'll end it on this note. Only 5 stocks down over 20%. You're doing great. Thank you, James. I appreciate that. But with that, guys, we are going to get into the 5 stocks that are just killing me. But once again, just another quick reminder, guys, right after the Dividend Happy Hour ends, we'll be jumping over to Patreon to keep the live stream going, keep the party going with the Dividend Happy Hour after party, and I will be swapping out this Coke Zero for a little margarita. So things are going to get pretty interesting, and I'll tell you what, my lady's at work tonight, so we're kind of bachelors over here, me and Peanut, so we might even go a little bit longer on the live stream. I think it's going to be a really fun after party, so I hope to see you guys over there. But anyway, guys, enough delaying. Let's get into the first stock, my first biggest loser. I want to make sure I'm caught up here in the live chat. Okay, my first biggest loser, guys, going over here is going to be wrong slide. It's going to be AT&T. Let's actually do this right here. So AT&T, just looking at their share price performance real quick, guys. In the last month, things were not great. They were down to over 13% just in the last 30 days, which was from their recent earnings report where, I mean, the top and bottom line numbers weren't too terrible, but the big thing was, and you guys probably remember this, they posted some lower than expected free cash flow. So they missed their free cash flow estimates by quite a bit, which has some people concerned about the dividend coverage and their ability to meet their free cash flow guidance for the rest of the year. But from what it seemed like, from what it sounded like from the earnings call, management expected this to be a lower free cash flow quarter. So we're just going to have to see how the rest of the year plays out. But nonetheless, the market did not like that, and hence the 13% drop. And we can see it really fell off a cliff right here. It was sitting around $20 per share. Now it's down to about 17. So quite a big drop, 13%, which brings them to a year-to-date loss, about 8.5% so far in 2023. But zooming out even more, in the last year, they are down 14%. So AT&T share price has really not been doing too well. And I'm pretty sure the price on this chart here is adjusted for the spinoff, for the Warner Brothers Discovery spinoff. So, but anyway, let's go take a look at my position real quick, just show you guys exactly how down I am. And switching over here, taking a look at my dividend portfolio tracking spreadsheet. This is my AT&T position right here. And let's actually zoom in just a little bit so you guys can see that a little better. Hopefully that helps. I have 101.5 shares of AT&T at an average cost of $21.60. So with the current share price of $17.13, I'm seeing quite a big loss. And specifically, guys, in terms of share price, I'm down over 20%. Like I said, 20.7%, which in dollars is about $450. So that's not a loss that tastes very good, but thank God for dividends, because on a total return basis, if we include dividends in the calculation, I'm only down 7%, and I'm only seeing a $155 loss, which definitely eases the blow. But nonetheless, seeing quite a big drop on AT&T, and just showing you how it's diversified in my portfolio. If we go over here, I actually have to zoom out again. Let's do that right there. AT&T, in terms of how it's weighted, is only 3.8% of my portfolio. So it's really not a big position compared to some others that I have, like Johnson & Johnson, which is over 8%, Lowe's, which is about 6.4%, Procter & Gamble about 9%, and then Starbucks also about 9%. So AT&T is really not a big position, which is in part a result of the share price just coming down so much. It's hard for this to become a big position when the stock does nothing but go down in share price. And if we scroll down, taking a look at how it's diversified by income, AT&T makes up 5.5% of my portfolio's total dividend income. So it's a little bit bigger. It's a little bit bigger of a weighting in terms of dividend income. And that's one of the reasons I'm really not looking to add any more to AT&T right now. I mean, I kind of figure, guys, just where it's at and the state of AT&T, if I'm going to be adding to any more high yield positions in my portfolio, I just think there's better ones that I could add to. I'd feel much more comfortable adding to EPD. I'd feel more comfortable adding to Main Street Capital Corporation, who also just put out a really good quarterly earnings report. ORCC, another business development company, Owl Rock Capital Corporation, or even KRC, which we'll talk a little bit more about momentarily, which is going to spoil some of the other, one of the other big losers in my portfolio. But anyway, let's move on, guys. I'm going to pull up the next biggest loser on the screen real quick. Just bear with me momentarily. Do you guys have any guesses as to what this next one is? I'll give you hints. It's kind of similar to AT&T, kind of similar along the same lines. I want to see if you guys can guess this one. Really, this was just an excuse to sip a little more Coca-Cola. I'll wait another. Okay, the results are kind of coming in. Yeah. All right, you guys are too smart. I see a lot of Verizons here. Yep, you guys guessed it. It is indeed Verizon, okay? And Verizon's share price performance is also not looking too great. I mean, in the last month, they're down 5%, which isn't as bad as AT&T's. And in fact, I think this right here, correct me if I'm wrong, but I think this right here is where AT&T, when AT&T posted their earnings. So just kind of out of sympathy, Verizon decided to drop in share price on the news of AT&T's quarterly earnings report. So not doing too good in the last month. Year to date, Verizon's down about the same. I mean, I guess all of their losses year to date pretty much came in the last month. But then in the last year, they are down 21%. And if we zoom out even farther across the last 5 years, they're in the red across the last 5 years, which isn't great, 20.74%. But while both of these, the share price performance from Verizon and AT&T are not great, I will say Verizon does have a little bit of a leg up over AT&T just in terms of the dividend stats. Now, both of their yields are in the 6% range, but I think at this point, Verizon's yield is almost a whole percent higher than AT&T, sitting just a hair under 7%, which is a nice and high yield. right? Not a high dividend growth rate to match, not a high 5-year CAGR, but that's okay. When you see a yield this high, you can't really expect it'd be a unicorn to find a stock with a yield this high and also a 5-year growth rate that's much higher than this. The only example that I can think of off the top of my head would be Altria Group, who has an 8% yield and also I think an 8% 5-year growth rate. But one other area that Verizon has the advantage over AT&T in the dividend stats is the dividend growth history. Now, while AT&T cut their dividend in the last year after the Warner Brothers Discovery spinoff, Verizon has continued to grow there. So they have an 18-year dividend growth streak, and I think the dividend payment history is a bit longer, 22 years. So some really nice consistency there. And then showing you guys my Verizon position real quick. If we go back over here, it's not looking too much better than... Actually, it's looking even worse. I take that back. It's looking worse than AT&T, but not by too much. I mean, Verizon, I have about 44 shares at an average cost of $51.40. Current share price, $37.83, which means I'm down, looks like about 6% more than my AT&T position. Seeing a loss of 26.4%, which is a loss of $600. You know, in the grand scheme of things, it's really, you know, this isn't going to break my portfolio, but I mean, I will say today, just where I'm at, spending $600 on anything is quite a bit of money. So seeing that I'm losing this amount of money does not feel good. But once again, if we work dividends into the mix, that does ease the blow a little bit. And on a total return basis, I'm only down I shouldn't say only, I'm down 18.66%. So on a total return basis, this loss is quite a bit more substantial than what I have with AT&T. Now, looking at the diversification real quick, it's a pretty equal weighting to AT&T. I mean, Verizon's actually a little bit less, 3.66%. But I think this wouldn't be the case if Verizon's share price, at least for me, didn't drop as much as AT&T. So Verizon, I think by cost basis, if we go back over here real quick, I think I might have more. Yeah, I do. I have more invested in Verizon, actually, than I do AT&T. So on a cost basis, which is the amount of money I contributed, this is my market value right here, which takes into account the losses. But the amount of money I contributed into Verizon is about $2,200, $2,250, which is, you know, a little bit more than my AT&T. But anyway, going back over here and just looking at the income from Verizon, once again, it's almost identical to AT&T. So AT&T was 5.54%. Verizon is 5.63% of my portfolio's annual dividend income. And I'm not adding more to Verizon for the same exact reason I'm not adding any more to AT&T. You know, I just think there's better high yield positions that I could add to in my portfolio if I want to add to any more high yield positions, which I don't know, I guess I have been. And actually that brings us to this next stock. And I kind of spoiled this one, guys. My third worst performer, if we go back over to the screen, is KRC. I'm going to put myself back on the screen right there so you guys can see all my thumbs up. I don't want you guys to miss out on that. But yeah, KRC is my portfolio's third worst performing stock. And since 2020, I mean, if we go back across the last 5 years, this stock has really taken a hit. It's down over 60% in the last 5 years. I mean, most of those losses have come just in the last year where they're down about 60%. But looking at this, if we go back to, let's go back here. So in 2020, their share price peaked at about $86 per share, which means that today at the share price of $28.31, that means the share price is reduced to about a third of what it was at its peak here. So that's really not great. But like I said, out of the 5 stocks, my 5 biggest losers, this is the only one that I'm actively adding more to. In fact, I picked up some more KRC this week. I added a pretty substantial tranche, at least for me. I invested another $225 into KRC and bought 8 more shares. So, you know, for me, that's quite a big purchase. Definitely a big addition to my position, which we'll take a look at more in just a moment. But just a little, I guess, background as to why I feel comfortable adding more to this company, even though the share price is just plummeting and it hasn't seemed to bottom yet. I think it does, which is why I decided to add more to it, but it just keeps seeing new and new lows. But really, guys, I'm only adding more to this company out of the other losers that we've seen so far, AT&T, Verizon, and then the other 2 that we'll talk about momentarily. I'm only adding more to this one just because I feel that the drop in share price has less to do with how the company is performing financially And fundamentally, it just doesn't seem like there's anything wrong with KRC. They're actually firing on all cylinders, and recently, within the last couple of weeks, put out some really good numbers for their. Let me do this. Sorry, guys. Right there. For their recent quarterly earnings. So if we go here, just so you can see the highlights, scrolling. Yeah, right here. So they beat on both the top and bottom line. Funds from operation beat by 5 cents. Revenue beat by over $10 million. And the revenue was up 10% year over year. So they're really putting up some strong numbers, like I said. And just showing you some of their financials real quick, just so you can see kind of how it's trending. Rental revenue, the rent that they're collecting every single year, let's do this, is going up and up very consistently. And if we were to switch and look at this on a quarterly basis, we would see that the same is true on a quarterly basis. They're bringing in more revenue each quarter compared to the last, if that makes sense. I know I worded that kind of weird. You guys know how it is with me. I get tongue-tied. My brain moves faster than my mouth does. I get all jumbled up. But anyway, looking at the bottom line too, the AFFO, or the funds from operation, adjusted funds from operation, this is trending up and up as well. And we actually probably should look at this real quick, just on a quarterly basis, because one of the I guess potential risks with an office REIT like KRC, and they're diversified in other areas too, but they have a lot of office exposure, is that offices have been out of favor since the pandemic started. But once again, look at the revenue. This is on a quarterly basis since September 2020. Every single quarter, for the most part, their revenue has gone up and up and up, all the way to the most recent one right here. So even in the face of weakened sentiment, people not feeling too hot about offices, with all the craziness going on in the banking fears and all that stuff, inflation, you name it, they're still putting up really good numbers. And FFO, once again, just like the revenue, is going up and up and up on a quarterly basis. And this last quarter, the one they just reported on, there was the highest FFO to date, actually, in their history, I believe. And if we look at this on a per share basis too, which is an important thing to do, I think, this is also trending up into the right as well. I mean, it was kind of stagnant for the last 3 quarters, but they managed to beat again and bring in record FFO per share just in the last quarter. So all of this is to say, guys, zooming back out, sorry about that, and sorry for the tangent as well. All of this is to say, I feel good adding to KRC just because fundamentally, sorry, a little bit of a runny nose. Just because fundamentally things are still looking really good with the company, and this share price drop, I think, is more a result of poor sentiment around offices, and also just all the different things going on, all the different macroeconomic concerns that have been bringing this company's share price down. And that's not to say things won't get tough for them as time goes on. I hope it doesn't, but in the meantime, they're still doing really well and firing on all cylinders. So I feel really good about adding to them. I know, sorry for the tangent, guys. But you guys know how I like my KRC. It's to be expected at this point. But looking at my position real quick, with that recent 8 share purchase from earlier this week, I'm now at 61 shares exactly. And my average cost is now officially under $40 per share, which is something that I've been working towards. So I'm really happy to see it finally get there. Still quite a bit above the current share price of $28.31. And looking at this loss, I'm down 28% with KRC, and my total return is not much better. Since this is a newer position for me, I only started buying into this company back in, I think, August of last year. So the total return is not going to be much better because I haven't collected that many dividends yet. But then looking at my loss in dollars, it's about $670, so quite a big loss. And looking at how KRC is diversified in my portfolio here, once again, still not a really big position, only about 3.8%. But this is kind of like Verizon and AT&T. Excuse me. This is because the share price keeps going down, and I have even more invested in KRC than I do AT&T and Verizon. I have about $2,400 invested in KRC. That's my cost basis, so I'm just down quite a bit. It's a bit depressing, but I'm okay with it when it comes to this stock because this is one that I do feel good about averaging down. As yeah, I've said about 100 times already, so excuse me for that. But then looking at KRC, how much income it's bringing in. It's bringing in that's Johnson & Johnson, excuse me. KRC is bringing in 6.5% of my portfolio's total dividend income, and because of that, that's how do I say this? That's a pretty substantial amount, I think. It's not close to, I mean, my highest income generators, if we go back over here, are going to be Altry Group, who's 9.5%, EPD 7%, JEPI, just a little bit above KRC here, and then even ORCC 7%. So it's not the highest out of my portfolio, but it's starting to get up there. I think this officially puts it in one of my top 5 highest payers. And so because of that, even though it's been nice averaging down and lowering my cost basis, and even though I still feel good about adding to this company, just because of how high the percentage, how do I say this? You guys, I'm so sorry. Just because it's bringing in such a high percentage, starting to bring in such a high percentage of my portfolio's dividend income, I think it's getting close to being time that I cool it on my KRC contributions. Gosh, Ryan, was that so hard to get out? Jeez. You guys know where I'm coming from. You guys know what I mean. So I don't want KRC to bring in, just in case I'm wrong. I feel really good about the company, but just in case I'm wrong for whatever reason, knock on wood, I don't want to be completely wrecked and lose out on 6.5% of my portfolio's income, because that's quite a chunk. In the grand scheme of things, it won't completely ruin me. I'll still be in the game, but nonetheless, I just want to mitigate any sort of risk of that happening. And so because of that, I don't want to have too much of my income coming from any one position, even if that one position or one of those positions is a relatively good-looking company, I think. Enough rambling on KRC, guys. I do it all the time. You get me, you bring up KRC, you get me going on it. I just have a hard time stopping. But anyway, let's switch gears, get into my second worst performer. The 4th stock we're talking about, my second worst performer. Let me take a sip real quick. I need to chill out for a sec. Sorry, guys. And real quick, we have 210 people now in the stream. I love it when we get over 200 people. Guys, thank you all so much for joining. Thank you for hanging out with me on this Dividend Happy Hour. Let's get into the second to last stock that we're going to talk about. We'll go through these last two relatively quickly because I want to get to the Q&A. But this 4th stock, my second worst performer, you guys probably could have guessed this one. It's Intel. Intel. Intel is down 30% in the last year. Wow. And then in the last month, they've seen a little bit of a drop as well, about 4.5%. But surprisingly, still year to date, Intel is up 16%. So in 2023, Intel is not doing too shabby. Where was it at the start of the year? It looks like it was about $26. We could definitely see it get back down there. I mean, it's even come lower so far in 2023. The lowest it looks like it's been is about just under 25 bucks. Hopefully it doesn't get that low. Hopefully it just keeps going up and up. I'd love to see this get closer to my average cost, but I will admit, and I kind of talked about this a moment ago or earlier in the video, if we go over here actually, after Intel cut their dividend, I will admit, after they cut their dividend, the dividend stats now are looking pretty dang weak. I mean, they only have a 1.6% yield. That payout ratio's terrible. And hopefully this will, as they get back into more on solid ground, that will change. But the 5-year growth rate's also abysmal, 1.28%. The 5-year growth rate's actually lower than the dividend yield, which is something that you don't see too often. But they have a dividend growth history of 8 years, which actually I don't even think is accurate because they reduced the dividend. So nothing about the dividend is looking good with Intel right now. But still, for better, for worse, nonetheless, I'm still hanging on to this company for now just to see if hopefully in the next few years they can turn the ship around. Or at least I'm looking to see if it can get back up to somewhere around my average cost per share, which will actually, on that note, taking a look at my position real quick. Sorry, guys, let's do that. Going back over here, my Intel position right here. So I have 63 shares. My average cost is $44.29. So if the share price, Ryan, slow down. If the share price could get back up above $40 per share, I would be so psyched. That would probably make my day, make my year even, because I'm taking quite a big loss on Intel right now. In terms of share price, I'm down about exactly 30%, and my total return is not much better. And then in terms of dollars, this is my worst loss that we've looked at in terms of dollars. In fact, I think across my entire portfolio, I'm losing the most money on Intel. I'm down $838. Really not looking too good for me. But once again, this isn't a really big position for me. I mean, it's 4.3% and would be a lot bigger, right, if the share price wasn't down so much. So what's my cost basis with Intel. Yeah, so my cost basis is actually kind of high, about $2,800. So that's a lot of money invested, taking quite a big loss, down almost $1,000, and I really haven't received much dividends from this company, less than $100. So my Intel position's really not looking too great. And then with this dividend cut, since they reduced it, the income across my entire portfolio is really low. It's only 1.5% of my portfolio's annual dividend income. So if they cut the dividend completely, that really wouldn't be a huge loss, which I guess is the silver lining out of all of this, if there was one. And it's only bringing in $31 of dividend income for me, which you can see is just compared to the rest of my positions is really low. I mean, Apple's only $6 in my annual dividend. I'm only bringing in $6 with Apple. Intel's my second lowest income generator. Coca-Cola, my third lowest income generator. Lowe's looks like it's fourth, but I'm really hoping to get Lowe's up there. If it comes back down in share price, I'll keep loading up on that. But anyway, guys, that's my second, excuse me, I keep doing that. Oh, wow, 245 people in the stream. That's awesome. That was my second worst performer, which is no surprise. And with that, guys, before I reveal my worst performer, do you guys have any guesses as to what the worst performing position in my portfolio is? You might have already seen it if you were looking at my spreadsheet there, but let me know if you can guess what my worst performing position is. I bet you guys can guess it. You guys are too good. Too good. Nothing gets by you guys, I'll tell you what. Yep, I'm pretty much everyone guessed it. It's, as Kevin Burgess says, it's 3M. It is 3M. It's my worst performing position. And real quick, while I've got Kevin's comment up here, next week, I meant to mention this earlier in the live stream, but next week, guys, Kevin will be joining us on the Dividend Happy Hour, which is going to be super exciting. It'll be really fun to be able to talk to Kevin. And actually, real quick, next week, we're going to have to push the Dividend Happy Hour back from Friday. We're going to have to push it back to Saturday. So next week's Happy Hour, I'll put out another announcement next week on it. But next week's Dividend Happy Hour, set your calendars, is going to be next Saturday. Not Friday. We're going to do it on Saturday. But anyway, getting into my worst performing position, 3M. Let me just pull it up on the screen. One sec. Okay. So 3M, guys, down 31% in the last year. Year to date, down 15.6%. In the last month, they're barely up a little bit, just 0.75%. And then over the last 5 years, 3M is down 50%. But it looks like they really started coming down. Nah, I mean, I guess right here, too, back in 2019, they really started coming down. And the pandemic hit. They went from 177 to a low of a little bit higher, actually, than where they're at now. Their lowest during the pandemic looks like it's about 117 compared to the current share price, 103. 3M is really getting close to being in the double-digit range, under $100. And in fact, they got there very recently. Looks like their most recent low was, well, their 52-week low actually is $100.16. So they were very close to being under $100 per share, which I've heard from a lot of you guys that that's kind of the price that you wouldn't mind buying 3M at again. I've heard from a lot of you guys have said, and maybe you've changed your stance on this, but you've said that if 3M gets under $100 per share, that's probably a deep enough margin of safety to maybe start adding to it again. Maybe, maybe not. I'm sure you guys can find better companies to invest in. I'm sure a lot of you guys would be staying out of 3M. I personally will not be adding any more to it, but anyway, just showing you my position real quick. Going back over here to the screen. Let's go over here. 3M. Okay. I really don't have a big position in 3M. 12 shares. Average cost 165. So look at that. That's a huge difference. Such a huge difference in current share price compared to my average cost. It's not even funny. Oh, it's depressing. But anyway, with 3M, guys, my share price losses are 37.5%, which is a whole, where's Intel? It's about 7% more than the loss I'm seeing with Intel. But in terms of dollars, Intel's still taking the cake. With 3M, actually, Intel, I'm losing about $100 more than I am with 3M. But still, this is nothing to stick your nose up at. A $740 loss with 3M, for me, that's still pretty impressive. And then total return, if we work dividends into the mix, I'm still down 30%. So that's really not helping me too much. But I'll take what I can get, to be honest with you guys. And then 3M, not a big position, 2.7%. What's my cost basis with 3M, actually? If we go over here, So even so, really not a lot invested in 3M. Still less than $2,000 invested. I've got much more invested into other companies, which is good. So even without these losses, 3M wouldn't be a big position for me, which is okay. In terms of income, it's a little bit more than how it's actually weighted. So 2.71% in weighting, 3.5% of my portfolio's income. I'm pretty comfortable with that. 3.5%. If 3M were to cut their dividend, which they're a dividend king, I think they've got 65 or 66 years of growth. If they cut their dividend, wouldn't be the end of the world. Miss out 3.5%. But anyway, those were my top 5 worst performing positions. And going through all of those, it kind of begs the question. Oh, there's the light again. Sorry, guys. Let me scoot back a little bit. Going through all of those, it kind of begs the question, like, would I sell out of any of these positions? I did mention, I talked at length about it, wouldn't shut up about it, that I have been buying KRC, so I definitely don't plan to sell that one. But as far as the other ones go, AT&T, Verizon, 3M, Intel, I'd be lying if I said I didn't think about it sometimes. I mean, I kind of touched on this last week. I do a lot of thinking out loud when it comes to rearranging my portfolio. You guys get the brunt of it. You guys are often on the receiving end of those conversations. And so I think about it sometimes, and I see pretty clear opportunities in my portfolio to cut my losses with some of these and reinvest the remaining funds into other, arguably more higher quality positions, like some of the ones I mentioned earlier. If we're talking just high yielders, EPD, Main Street, I think those are better high yielders, or even reinvesting into some of the better ones, the ones that have been better for me, like Starbucks or Lowe's, Snap-on. Gosh, I'm sorry, guys. And I've even thought about starting a new position in Williams-Sonoma, which is something that I do plan to do at some point in the near future. I'm kind of waiting for their earnings to come out. So there's opportunities, like I said, to cut my losses, trim the weeds, and reinvest into some of the other positions in my portfolio, or start new positions in probably what are better companies. And although I'm down quite a bit on all these positions, I guess my justification for holding on to them, if I needed to come up with one, probably just pulling this out of my butt, but the justification, I guess, for holding on is just they're not really hurting me. I mean, I'm losing money in terms of share price, but they're still cash flowing. They're still paying really nice dividends. So, with the exception of Intel, but because of that, because they're still cash flowing, I just don't see much of a reason to trim them. I guess I just don't see much of a reason. I guess I don't see the harm in continuing to hold on if they're still paying those nice dividends. But having said that, the question I ask myself is that a good enough justification? Just because they're still paying a dividend, is that a good enough justification to continue holding on? And truth be told, I don't really know. I don't really know what the right answer is to that question. That's something that I'm sure will come to me in time. But for now, I don't mind holding. Hopefully, my share price returns get better with some of those. I don't expect things to happen too quickly with any of those. I don't expect 3M or Intel or Verizon to jump back up in share price anytime soon. I mean, stranger things have happened, but I'm not holding my breath on it. AT&T is kind of a wild card, though. I think anything can happen with AT&T, so it should be interesting to say, or interesting to see. But with that, guys, I want to put it back on you and ask you, what is the biggest loser in your portfolio? Out of all the stocks that you own, which one are you seeing the biggest losses on right now? And if you want to name a few of them, and instead of just one, feel free to do so. Let me know in the live chat, or if you're watching the replay, let me know in the comments below. But yeah, what's the biggest loser in your portfolio, and how much are you down on it right now? I'd be very curious to hear if maybe we have any of the same ones. I can't help but think I'm not the only one that is taking a loss on Intel and 3M and whatnot. So let me know there. I'll put some of them up. Put some of them up on the screen. So, and real quick, I see you guys chattering about Kevin's conversation with Russ, and I listened to it earlier today. It's a gift. It is a gift from the gods. It is a gift from the dividend investing gods to us here in the dividend investing community. Really awesome conversation. I highly recommend you guys check it out over on Russ's channel, Russ Knop Dapper Dividends. I mean, if you guys watch my channel, a lot of you guys watch his as well. So definitely go check out that conversation. It's going to be one of the best things you listen to, one of the best dividend investing things you listen to this week. I guarantee it. So let's see here. See some of your guys' biggest losers. I'm going to put them up. So Pat here, his biggest losers are 3M and MPW. So cool that we have 3M in common there. Adam here, okay, so I don't feel as bad about some of my positions. No offense, Adam. FRC, I lost basically 100% around $2,000. Wow. But even so, going back to this, so the good thing about, I guess the good thing about, I shouldn't say the good thing, but the thing to keep in mind about this is $2,000, you know, in the grand scheme of things, it's really not going to be a huge deal down the road. At some point, Adam, in your investing career, you're going to be making $2,000 of dividend income in a month. So, you know, and that's kind of the mindset I try to have with some of these losers. If I were to cut my losses, if I were to sell and tax loss harvest some of these positions, it's like, you know, in the grand scheme of things, it's not going to completely ruin me. It's the cost of tuition, I guess, to learn my lesson, whatever that lesson is. Practical Investing says his biggest loser is realty income. Okay. And I'd be curious, what's your average cost? Like, how much are you down with realty income right now? Because realty income, I feel like, has kind of stayed around. I don't think it's fluctuated too crazy in share price for a while. So yeah, I'd be curious to hear. USB, biggest loser for, I'm not sure how to pronounce your name. I'm not even gonna attempt that one. I really apologize. But USB, Shamir's biggest losers are CM and BAT. Which company is CM? I don't recognize that ticker. Okay, Canadian Imperial Bank of Commerce. I promise you guys, this is just Coca-Cola. And then BAT, that's not British American Tobacco. Is that Batero Gold? Is that another Canadian company? Fabio, CVS. Yeah, CVS is actually looking like a really deep discount right now. I just added that one to my watch list because I noticed that it had really come down in share price. So I'm going to be doing some research into that one. Adon here, biggest losers, Intel and SNXFX, which sounds like it's maybe a mutual fund or an index fund, perhaps. Let's see. Sean's lucky, actually. His portfolio has been all green, up 2%. Okay, practical investing is only down 5% on realty income. That's not bad at all. So that's good stuff. Anthony's biggest loser is AT&T, only down 8.7%. That's not bad either. That's really not bad. Luis, same here. His biggest losers are 3M, AT&T, FRT, VFC, and VZ. So we've got 3 of them in common. Okay. Jack here, 3M is his biggest loser at 24%. Looks like Carl's holding GNL down 20%. Shaded Light, 3M. We got MPW from Carlos. Swampy Kips, Bank of America down 18%. My man David here down 30% on USB and DLR. And real quick, guys, I got to say, I had the pleasure of, actually my entire family and I had the pleasure of meeting Dave, who's a Las Vegas local, a few weeks ago. And I just want to say, Dave, once again, it was a pleasure to meet you, man. And yeah, real pleasure to meet you. And hopefully we'll get together again sometime soon. And with that said, too, I know I've mentioned this before. If any of you guys are ever in the Las Vegas area or going to be visiting or whatever, hit me up. Let me know if and when you're coming to town. I'd love to, if it worked out, I'd love to get together and buy you a margarita. So keep that in the back of your guys' mind. I think it'd be a lot of fun. But anyway, yeah, let's just move on. I won't even get into it. Gorilla Nurse, MPW, and USB are two biggest losers. Professor Joe, MPW. TCAF, biggest loser. SCHD down 239. Okay. Pfizer and MPW. And I'll go through these a little bit more quickly, guys. Richard, PSEC, biggest loser. Looks like Jim's down 46% on MPW, 36% on CCI. Is that Crown Castle? Is that what that company is? And then 25% on USB. I'm seeing a lot of USB. Okay, Carlos down 50% on Intel. Journeyman down on Intel. I might have screwed up Carlos. Down 50% on MPW. Excuse me if I screwed that up. Phil's down on AT&T and Walgreens. Shaping down on IEP, which is Icon. Is that how you pronounce it? Enterprises. Kevin's down on SCHD. But that's the thing about being down on SCHD is just you can average down. That's no sweat. No sweat. Kevin's down 27% on Stanley Black and Decker and 21% on Whirlpool. I will say though that both of those are probably good ones to be down on. I mean, both of those definitely discounted, right? But also both really great companies. Actually, I just went to Lowe's a couple days ago and I had to buy a drill, so I bought Craftsman drill um, with like a 60-piece drill set. So you're welcome to all you Stanley Black and Decker shareholders. And I bought it at Lowe's too, which helps a lot of us out. So I'll be recouping some of that in the form of dividends, which is thank goodness for dividends. Anyway, let's keep going here, guys. I see a lot of you guys are down on like SCHD and 3M. A lot of different companies actually. And then Jim here says, this is a good way to look at it too. Having 75 positions, I don't sweat the losses as much. But let's keep going down, guys. Let's get into some other Q&A stuff here. If you guys have any questions that you put up in the earlier in the live chat and I missed, go ahead and submit them again if you wouldn't mind, so I can get them answered for you. And then once again, too, we've got about probably 15 minutes left in this live stream. In the Dividend Happy Hour. Then we're going to jump over to the after party, which in case none of you guys have ever heard about it, I mean, I know I've mentioned it a couple times, but the after party, which you can find right here by joining the Patreon community, it's just another bonus live stream that we're doing every single week, and it starts immediately after the Dividend Happy Hour ends. Actually, tonight, right after the Dividend Happy Hour ends, I'll need like 3 minutes to make myself a margarita. Then we're getting back into it for another hour or so. Maybe even go a little bit longer, depending on how much fun we're having. If the conversation's flowing and we're having a good time, we'll keep the party going till the cops show up, I guess. So, because like I said, I'm a bachelor tonight. My lady's at work. Me and Peanut are, well, he's taking a little nap down there. Me and Peanut are the men of the house, so we're gonna have some fun. Let's see here. Okay, so this is a good question. I actually was asked this one by Pat, who I said we'd cover it on the after party, but we'll talk about it now. When will J&J shareholders get Kenvue stock? So for those of you who don't know, Kenvue is the consumer packaged goods company that J&J just spun off, and it contains brands like Tylenol, Listerine, Neutrogena, Band-Aid. You go look in your medicine cabinet, you have probably a lot of these products. So J&J just spun that off into its own company, and at some point, we Johnson & Johnson shareholders are going to be getting some shares of Kenvue stock just for being shareholders of J&J. Now, my understanding is that we still have yet to find out a lot of the specifics as to when, and also how many shares we're going to get. Excuse me, I know there's been some rumors floating around, but from what it seems like, we should be getting the Kenvue shares in maybe another half a year. I think it's going to be sometime I think it's going to be sometime in November, actually, that we'll officially be getting the Kenvue shares. And as far as how many Kenvue shares per Johnson & Johnson shares you own, I'm not sure. I don't think that that's been set in stone yet. So we're just going to have to find out as time goes on. And with that, I mean, have any of you guys thought about what you're going to do? I think it's too soon to tell for me personally, but have any of you guys thought about what you're going to do with those Kenvue shares? Do you plan to hold on to them? Do you plan to sell them? You're going to buy some more? What do you think you're going to do with your Kenvue shares? I'd be curious to know. Let's see. Lil Teapot says, are you a sell in May and go away investor? No, I'm not. I'm a buy every single week kind of guy. Sherar, is that how you pronounce your name? Asks, what is the chance of a brokerage going bankrupt? I mean, I haven't heard rumors of any brokerage going bankrupt lately, but I actually just made a short about this that I have yet to post. But someone asked, what happens if your brokerage was to go out of business? What happens to your portfolio? Do you lose out on that money? What's the deal? Is that something to be concerned about? And there's a couple things that happen. So let's say hypothetically your brokerage does go out of business. Let's say Charles Schwab or Robinhood or whatever you use just is no longer in business. So first and foremost, you're covered by the SIPC, which I don't know exactly what that stands for. Let me actually look it up. SIPC, Securities Investor Protection Corporation. So you're protected by the SIPC and essentially insured in your portfolio for up to $500,000 in assets. So if your brokerage closes down, you're insured. You're basically covered up to $500,000. But what would most likely happen is another brokerage would probably swoop up and take control of the closing brokerage's entity or assets, excuse me. So if Charles Schwab, if Robinhood was to go out of business, Charles Schwab could step in, buy all of the assets under management for Robinhood. I don't know if that's the right term to use, but buy all of Robinhood's assets, and then you as the Robinhood user would then just start using Charles Schwab, and nothing would be affected besides that one thing. You would just switch to using a different brokerage. So I wouldn't worry about it too much. I haven't heard any concerns about any brokerages going out of business, but if they do, you should be covered. And if this is something that you're concerned about from a long-term point of view, it's not a bad idea to have brokerage accounts at different brokerages. So having one at Robinhood or having one at M1 Finance, one at Charles Schwab, one at Fidelity, kind of having some in different places. So let's see here. Yeah, I see a lot of you guys asking about the Kenvue spinoff. Hopefully I answered your questions about that. Stay Humble says, dang, guess I'm joining Patreon. Let the drinks flow. Yes, sir. Please join the Patreon. And we've been having a lot of fun there over on the after party. And we have a Patreon exclusive portfolio called Peanuts Portfolio that we're actually building there. I have some serious updates for you about that because there's been some trouble with that portfolio. But yeah, so there's a Patreon exclusive portfolio that we'll be talking about every single week, and I'll be adding to every single week in addition to my main portfolio and my Roth IRA. So whole new separate portfolio, Patreon exclusive, and it's a fun one that we're all working on together. So it's kind of been a group effort so far as to which stocks have gone in it and which stocks will go into it in the future. And also, I'm going to be talking more about this on the after party as well. But we're going to start doing portfolio reviews. A lot of you guys have been asking for portfolio reviews. And we're going to start doing that over on the after parties as well. And actually in the link or in the description of this video, there's a link to a form to fill out and I'll talk more about this in the after party, but for the portfolio reviews, there's a link in the description to basically fill out your information to submit your portfolio to be reviewed by me on the after party. And there's some disclaimers in there. Just, this is just kind of for fun. I'm not a professional, obviously. This is going to be a pretty mediocre opinion, but it's for fun. But anyway, if you guys want to check that out and have your portfolio reviewed, there's a link in the description to fill out the form, but you do have to be a part of the Patreon community. And there's a link to it in the description of the video as well, or this right here. And it's also on the forum. It's all over the place. But anyway, continuing on, we've only got a few minutes left in this stream. I don't want to keep shoving the Patreon down your throats. That's the last I'll mention it. Let's keep going here. Okay, this is a good question. What are your thoughts on IIPR, which is Innovative Industrial Properties? It's a real estate investment trust that leases property to businesses in the cannabis space, a lot of growers, stuff like that. And I have kind of mixed feelings about this company. Let's actually take a look. Let's actually take a look at IIPR real quick. So if we go over here, IIPR, there's some things I like about IIPR. I mean, right now it actually looks to be at quite a nice valuation. Very low P to FFO. Share price has definitely come down in the last year, which that's one of the things about this company. It is pretty volatile in terms of share price because it's pretty dependent on the cannabis industry as a whole, which itself is pretty volatile just because of how it's regulated and stuff like that. So I was looking for the beta. Yeah, so the beta right here is 1.33. And for those of you who don't know, the beta measures volatility in relation to the overall market. So a beta of 1.0 means that the company moves up and down in share price at about the same pace as the entire market, is like the S&P 500 or something like that. If you have a beta greater than 1, it's trading with more volatility, so you'll see more swingy share prices. And if you have a beta under 1, it's the opposite. It's less volatile, so the share price movements aren't as aggressive. But I'll tell you what I do like about IIPR is so far as the financials. It looks to be growing really well. I mean, we're seeing some really solid revenue growth over the years, but it does look like it has, and we're actually looking at this on a quarterly basis. Let's look at it annually. Every single year, they've seen some really solid growth in the revenue, and the FFO is the same story. Some really solid growth in funds from operations, which is what they use to pay the dividend. And I think so far, too, if we look at the dividend per share, where is the dividend per share? Am I missing it? Yeah. The dividend per share has been growing at a really aggressive rate. Look, guys, just in the last few years, 2017, it was at 55 cents per share, compared to 2022, $7.10 per share. So there is definitely some good here. And jeez. This is another one of those unicorns where you've got the high yield and the high growth. But the dividend stats are killer. Really nice. There's just some risk and volatility that comes with this company, as we can see from the share price. And I think in a lot of investors' minds, the future success for IIPR in some part will be determined by the expansion of the cannabis industry. And so we'll just have to see how that all plays out. But, could be a good one. But I don't have any real concrete, serious thoughts on it. I really haven't done too deep a research into IIPR. So let's see here. A couple more questions, and we're going to wrap it up. Oh, this is a good question. So Trevon here says, Ryan, why don't you buy any bank stocks? And that's a really good question. The regional banks I haven't touched because I don't really know enough about them. I'd feel more comfortable, I think, investing in a regional bank that was like in my area. But the ones that I've looked at, like OZK, LNC is not a regional bank, but OZK, I think there's another, oh gosh, there's another regional bank. It's got an N in the ticker symbol. First something. I don't remember the name, but I don't really know anything about those banks beyond what the financials show. So I just didn't really feel good about investing in them because I don't really understand the communities. I'm not at all familiar with the communities they serve. And I think that's kind of an important component. In my mind, that's an important thing to have a good grasp on when it comes to investing in regional banks. Now, as it pertains to investing in the bigger banks like Bank of America or JP Morgan, I've come close to it. Recently, I had Bank of America on my watch list. I came close to adding it to my portfolio, and I don't exactly know why I didn't add it to my portfolio, to be honest with you, because I've been a Bank of America customer for a long time. I have a pretty good grasp on the company, but maybe I just didn't feel like, even with that, maybe I just didn't feel like I understood how to analyze a bank. So I felt that it was something that I had best stay away from. So hopefully that makes sense. Hopefully that answers your question. But in short, I just don't know that I understand banks that well. So for now, I'm kind of sticking to the sidelines on them. Let's see. Financial Freedom with Dennis says, opinion on KRC debt maturity and leverage. I don't have any serious opinions on them. I don't know. I don't remember. I think they mentioned it in their earnings call about the debt maturity. I don't remember when they said a lot of their debt was coming due. I actually remember seeing it in the presentation, and I think some of it's coming due in the next couple of years, and then it's kind of chill for a little bit, and then maybe about 10 years out, there's some more debt coming to maturity. But it didn't seem like anything too crazy in my mind. And as far as leverage goes, they do not seem over leveraged at all, from what I can tell as well. So I feel pretty good about KRC's balance sheet. I think that's one of the stronger aspects about that REIT, actually. So what the heck? Portfolio review is a bad idea. Sorry you broke down. Okay, whatever that means. It broke down. Sorry, Steve. I don't mean to have a weird reaction to that, but I don't know what you mean by broke down. I think that's a weird thing to say. Um, let's see here. Let's go one more comment and then we'll yeah, then we'll get going. Okay, this is actually good, Caleb. I would recommend reading the Bank Investor's Handbook. It teaches you all the basics of banking and how banks work. I think that'd be a really good thing for me to check out. Actually, I'm going to Google it. The Bank Investor's Handbook by Kenneth Yellen. Okay. Oh, it's only like $13. Yeah, I'll definitely I'll add that to my reading list for sure. And this, to Shamir's point too, this is another thing that I've heard as well. I stay away from U.S. banks as an investment. Don't really trust them as much as Canadian banks. And I've heard so many times how strong Canadian banks are, but I've just not looked into them myself. I think though, Caleb, I think that's going to be a really good resource for me. I'll definitely check that out. It kind of reminds me of like, I bring this up. I show this book all the time. The Warren Buffett and the Interpretation of Financial Statements. This seems like, just at a glance, it seems like the book you mentioned is maybe just like the bank specific version of that. But anyway, guys, I think this is a pretty good place to wrap it up, unless you guys have one last question for me. But otherwise, I'm just scrolling back up in the comments real quick. Okay. This is a good last comment. Good note to end on. What do you think of industrials at the moment? A lot of interesting companies with really long histories at fair or otherwise discounted prices with tempered. Yeah. So I got to say, the industrial sector has become one of my favorite sectors just because within the sector, there are so many different industries. And there's just so many really cool businesses. Just some of the ones that come to mind that I have, well, not just the ones that I have, but Snap-on's really cool. You've got some really cool railroads. You've got Rollins, which is a company that I've been looking at for a while. Really strong industrials company. Waste Management. There's some really great companies in there. Some really important companies too. And I think is John Deere, well, Caterpillar's in there. So John Deere's probably in the industrial sector as well. So there's some really good companies in there. I think it's a great sector. I think in my portfolio, what do I have? Let's actually, if we go, just looking at my industrials companies, I've got Lowe's isn't industrials. That's discretionary. I guess I just have a couple of them. Snap-on, 3M. That's it, I think. Yeah, Snap-on and 3M. But anyway, guys, really good. Oh, LMT, that's another good one too. Yeah. What has Lockheed Martin done? I really haven't kept tabs on Lockheed Martin since I sold out. So really since I sold out of them back in, I think, November, it's actually gone down a little bit or have stayed about the same. So, okay, feel pretty good about that move. But anyway, guys, this is a good place to wrap it up. So with that, I look forward to seeing you guys over in the happy hour, or the after party, excuse me. But for those of you who are not joining us tonight, I hope you have a fantastic weekend. Sunday's video is going to be a really good one. So yeah, I'm stoked to see you guys on Sunday. Hope you check out that video. Otherwise, I hope you have a fantastic weekend. Have a safe weekend. Good Cinco de Mayo as well. And you guys keep up the good work. So yeah, I'll see you in the next one.